Every item in your grocery cart carries an invisible surcharge you never agreed to pay. The aluminum in the can, the diesel that moved the truck, the natural gas that powered the factory, all of it spiked in cost before the product ever reached the shelf. And the companies that make your food are being quietly crushed under the weight of it, which means the price you see on the label is about to get a lot worse. $2.58 trillion. That is what the United States spent on food and beverages in 2024. And most people assume the bulk of that number goes to farmers. The reality runs in the opposite direction. Raw agricultural ingredients account for only a fraction of total food costs, because the manufacturing and distribution ecosystem swallows the rest. The packaging, the transportation, the energy needed to process and preserve what you eat. According to the International Energy Agency, direct and indirect energy costs can represent up to 50% of total variable costs for food production in advanced economies. That single number tells you everything about why food prices follow oil prices, not harvest yields. And that connection has been tested brutally, more than once. During the 2007 to 2008 global food crisis, skyrocketing oil dragged the cost of industrial agriculture, mechanized harvesting, and global food transportation up with it. The Baltic Dry Index, a composite indicator for global bulk freight costs, hit an all-time high of 11,793 points in May 2008. Natural gas in the United States peaked at $10.03 per million BTU during the same window, gutting the margins of every manufacturer that depended on it. Because natural gas feeds directly into the production of nitrogen-based fertilizers and powers the glass smelting and metal packaging lines that make food containers. That crisis proved something economists had suspected for years. Fossil fuel volatility acts as a compounding multiplier across the entire food value chain. 14 years later, the 2022 Russian invasion of Ukraine drove the lesson home again. Russia and Ukraine together represented over 30% of global wheat exports and nearly 20% of global corn exports, covering more than 10% of global caloric consumption. What hit downstream food manufacturers hardest, though, was not the missing grain. It was the disruption of natural gas supplies flowing into Europe. Ammonia production, which depends heavily on natural gas as its primary feedstock, collapsed across the continent. And here's the connection almost nobody talks about. Food-grade carbon dioxide is primarily captured as a byproduct of ammonia synthesis. When fertilizer plants shut down, CO2 supplies vanished along with them, crippling beverage carbonation, halting frozen food production, and disrupting the meat processing facilities that rely on CO2 for livestock stunning and chilling. The global food-grade gas market is projected to reach $8.8 billion in 2026, and as of January 2026, the Producer Price Index for industrial nitrogen still sat at a highly elevated 262.37, locked in a structural plateau far above pre-2022 levels. None of those crises compare to what started in 2026. Following joint U.S.-Israeli strikes on Iran in late February, the Strait of Hormuz has been effectively closed to commercial shipping. That single maritime choke point normally handles approximately 27% of global crude oil exports and 20% of global liquefied natural gas. Crude oil breached $100 per barrel almost immediately, and Goldman Sachs projected a potential run toward $150 if the blockade persists. The European Central Bank estimated the restriction alone could push global inflation up by 0.8 points. Fuel prices only scratch the surface of the damage. Between 20 and 30% of global fertilizer exports flow through the Strait of Hormuz, including 35% of global urea exports and 45% of global sulfur trade. The timing could not be worse, landing just as the Northern Hemisphere enters peak spring planting season. Global urea prices jumped roughly 26%, climbing from $465.50 to $585 per metric ton by March 2026. And for U.S. agricultural producers, the hit landed even harder, with urea prices surging 77% between mid-December 2025 and March 2026. As nitrogen costs become prohibitive, farmers will abandon fertilizer-intensive crops like corn in favor of soybeans that fix their own nitrogen. Corn sits at the foundation of the global poultry, pork, and beef industries, which means a massive reduction in corn acreage sets up severe supply imbalances for meat processing, dairy, and egg manufacturing stretching through 2026 and 2027. Running parallel to the oil and fertilizer disruption, the Hormuz crisis has gutted the global aluminum supply chain. The Gulf region produces more than 8% of global aluminum output, over 5 million metric tons annually across Bahrain, Qatar, Saudi Arabia, and the United Arab Emirates, nearly all of it shipped through the strait. Gulf smelters now face a punishing dual squeeze, unable to move finished aluminum out of the region and simultaneously cut off from the imported bauxite needed to keep their operations running. The Qatalum smelter in Qatar initiated a controlled shutdown in March 2026 after drone attacks severed its natural gas supply, and Aluminium Bahrain declared force majeure on certain deliveries. Benchmark aluminum on the London Metal Exchange spiked to $3,544 per metric ton in March 2026, the highest mark since 2022, and the physical metal market plunged into deep backwardation, with the cash premium hitting $47.40 per ton, a clear signal of panic buying among industrial users. Layered on top of the geopolitical chaos, U.S. food manufacturers face punishing trade tariffs that compound every other cost increase. Section 232. Tariffs impose an effective 50% duty on imported steel and aluminum, and because tinplate steel is a highly specialized product, used almost exclusively for food cans with limited domestic manufacturing capacity, those tariffs drive domestic packaging costs well above global averages. The gap between the U.S. and global packaging index widened to $300 per metric ton in late 2025 and early 2026. The U.S. Midwest Premium, which is the surcharge added on top of the base aluminum price, broke past $1 per pound for the first time ever. Food manufacturers producing canned goods, frozen meals, and carbonated beverages absorbed direct packaging material cost increases of 9 to 15%. And the aluminum tariffs alone have extracted over $1.89 billion from the U.S. beverage industry. And this is where shipping consolidation makes every single one of those problems worse. Between 2010 and 2025, the top 10 global container lines expanded their collective market share from 55% to an overwhelming 86%. The Ocean Alliance controls about 28.4% of global capacity, and the newly formed Gemini cooperation between Maersk and Hapag-Lloyd holds 21.6%. During disruptions, these alliances deploy coordinated blank sailings, canceling scheduled voyages and rerouting fleets to artificially constrain capacity and charge astronomical spot rates. When input costs spike this violently, food manufacturers face a brutal question: how much of the increase can they actually push through to consumers? The answer is far less than most people assume, and it takes far longer than anyone can afford. Research shows it takes an average of 8 quarters, a full 2 years, for manufacturing sectors to pass through just 80% of a given input price shock. The dynamics follow what economists call the rocket and feather pattern, where manufacturers push upward cost shocks through at rates exceeding 100% in absolute impact. But when those costs eventually fall, downward price adjustments land at only 58%. Prices rocket up and feather down. The Federal Reserve measured the average cost price pass-through rate across firms at roughly 60%, which means for every $1 increase in supply chain costs, the average manufacturer raises prices by only 60 cents and absorbs the remaining 40 cents internally. That 40 cents lands in the gap between a 36.56% average gross profit margin and an 8.54% average net profit margin in food manufacturing. Packaging alone, which most companies miscategorize as a routine procurement line item, can consume a staggering 65% of total revenue for emerging food manufacturers during scaling phases. Corrugated material prices continue climbing at severe rates, with Rabo Research projecting an 11.4% annual price increase through September 2026, and those corrugated materials lose 50 to 60% of their compression strength in the cold, wet environments of food processing, driving product damage rates up to 11% at distribution centers. Freight and logistics eat up to 40% of revenue in packaging-heavy operations, with fuel surcharges compounding at 1 cent per mile for every 6-cent increase in diesel above a predetermined baseline. Energy accounts for 15% of operating costs, and within the first year of a 10% electricity price increase, food processors can only cut consumption by about 4%. Industrial electricity in the U.S. hit an all-time high of 17.14 cents per kilowatt-hour in early 2026. And during recent energy crises, the European food inflation rate spiked to 18.4%, alongside energy inflation of 20.6%. What all of this produces is a ruthless round of corporate Darwinism. Inflationary shocks hand market share directly to highly differentiated, high-markup firms, while grinding their low-markup competitors into dust. Nestle captured broad market share gains across pet food, coffee, and frozen meals. Kellogg posted an extraordinary favorable price mix of approximately 18% in 2023, more than enough to offset a 3% volume decline. Unilever absorbed a 15% increase in input costs by pivoting toward premium products, holding its underlying operating profit flat at 2.3 billion euros through sheer pricing power. For companies trapped in the squeezed middle, with neither the pricing power to push costs forward nor the scale to dictate terms backward, the damage is terminal. J.S. Wright, a UK engineering firm, fell into administration in late 2023 after fixed-price contracts made it impossible to pass on cost inflation, and its cash reserves collapsed from £9.9 million in 2021 to just £850,000. United Site Services, a company that had completed roughly 80 acquisitions by 2010, unraveled when inflation across fuel, vehicle maintenance, and labor chewed through its operating margins, while rising interest rates made its debt impossible to service. Private label products tell their own side of this story. Store brands have shed their budget image and now capture nearly 20% of U.S. grocery sales and up to 50% in some European markets. Without national advertising budgets to fund, their cost structure skews heavily toward raw materials, which makes them disproportionately exposed to commodity shocks. They keep gaining volume anyway, because the absolute price stays nominally lower, in a world where consumers are watching every dollar. That consumer behavior maps onto a K-shaped economy that is splitting the food industry in half. Higher-income households continue trading up to premium products, while lower-to-middle-income consumers aggressively shift toward private labels, discount retailers, and home cooking. That bifurcation hollows out the profitability of traditional mid-tier food portfolios, and because consumers resist further price increases, major retailers refuse to absorb cost pass-throughs. Walmart alone captures over 21% of all CPG spending in the United States, which gives you an idea of the leverage sitting on the other side of the negotiating table. On the corporate finance side, the outlook carries just as much weight. Only 60% of inflation episodes resolve within 5 years, and even successful disinflations take more than 3 years to complete. Most unresolved episodes follow a pattern of premature celebration, where inflation appears to decline but then stalls or reaccelerates. Equity markets have already priced in the pessimism. From late 2020 onward, the MSCI World Value Index outperformed the MSCI World Growth Index by more than 15%. Unilever Indonesia watched its EV to EBITDA multiple collapse from 20.5 times in 2022 to 13.4 times by 2024, a near 35% contraction that dropped its enterprise value from 178.8 trillion rupiah to 72.3 trillion rupiah. At the other end of the spectrum, PT Adaro Energy, a coal producer perfectly positioned as an inflation beneficiary, posted a 43.4% return on equity in 2022. Emerging market debt adds another layer of pressure underneath all of it. Entering 2022, approximately $7 trillion in emerging market corporate and sovereign bonds and loans were scheduled to mature, with 82% of that corporate debt denominated in US dollars and 24% rated speculative grade. The share of covenant loans in the leveraged loan market had surged from just 10% in 2007 to 80% by 2020, creating what amounts to a non-default shock amplification mechanism buried in the financial plumbing. History makes the outcome predictable. During the 1970s oil shocks, the Japanese share of the U.S. auto market more than doubled, from 9.3% to 20.9%, as fuel-efficient designs exploited the structural exposure of Detroit's gas-guzzling fleet. Over the past century, the asset share of the top 1% of U.S. corporations surged from 70% in the early 1930s to 97% by the end. The food industry sits in the middle of the same dynamic right now. Packaging mega-suppliers are consolidating at breakneck pace, with the Amcor-Berry global merger creating a $25 billion revenue entity, promising over $650 million in annual synergies, and the $21 billion Smurfit-Westrock merger, permanently eroding the negotiating leverage of mid-sized food brands. The era of hyper-efficient, low-volatility supply chains is over, and the numbers prove it. 81% of global supply chain leaders have implemented plans to increase dual sourcing of critical raw materials. 80% of executives have boosted baseline inventory holdings to guarantee production continuity. Indofood CBP, Indonesia's dominant instant noodle producer, deliberately let its inventory turnover drop from 7.0x in 2021 to a 5-year low of 6.4x in 2023, a calculated choice to hold heavier buffers against rising global wheat prices rather than chase efficiency on paper. The companies that survive this era will not be the ones that simply slash costs. They will be the ones that treat procurement as a financial profit center, enforce dynamic pricing governance under strict regulatory compliance, and build genuine inventory resilience where time to survive consistently outpaces time to recovery. The cost of operational redundancy is real, but it is nothing compared to the cost of operational collapse. What we are watching unfold across the global food industry is not a temporary disruption that passes in a quarter or two. It is a permanent structural transformation in how the world feeds itself.